Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have back the CEO, Alex Baluta from Flow Capital. Flow Capital trades on the TSX Venture Exchange under the symbol FW. The company is trading at 56 cents with about 31 million shares outstanding, or about a $17.5 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Alex, great to have you back. It's been a fair while since we've seen each other. But nevertheless, a lot of progress within the business. Great to have you back to tell us about some updates of the business. But for those that are sort of new to the story, why don't you refresh everybody's memory and what Flow Capital is all about?
Thanks, Paul. Thanks, Trevor. Good to be back. I think this is our third time. One of the things, I was an equity analyst in Canada, Marlowe Mere Securities, if you remember that name, then Midland Wallman, then Merrill Lynch, then in the US at Robertson Stephens. Now, I'll tell you, one of the things I remember is tell people what you're going to do it, come back and tell them again, do it again, come back and tell them again and do it again. And as best you can, under promise and over deliver. And I know that's kind of a cliche, but I think that's what we've done. And I'm proud to be able to talk about that. So thank you for giving us the platform 3 times now. So Flow Capital is a lender. That's the simple definition, but we play in a space called venture debt. Don't let the word venture scare you. It's more of we lend to high growth companies. And the tag, basically, we're much more flexible than bank debt, and we're much less expensive than venture capital from a cost of capital perspective to the entrepreneur and existing shareholders. And so for companies that have nailed their value proposition, so they're revenue generating, they're really scaling their businesses, they're growing, we can help them scale that business in a very cost effective way. And what's important to think about is that we take debt risk. So we have senior secured notes on the top of the company's cap stack, generally in companies that have more than 5 million in revenue. In fact, we were just looking at this the other day. Our average revenue at investment of our companies is in around the $5 or $6 million US range. So we sit senior on the cap stack. We're taking debt-like risk. And what's really worked for us is we take 15% cash interest minimum, which sounds expensive, but if the company's growth rate is higher than that cost of our capital, so if the nominal cost of our capital is 15%, but they're growing at 30, then we are always cheaper than the alternatives from an equity perspective. Because generally a company's equity value will grow at the pace of its equity of its revenue growth or earnings growth. And so our value proposition to those companies is, we'll help you grow with a minimally dilutive solution. And then when your value is our average loan is 2 to 3 years, sometimes 4 years down the road, when your equity value is several multiples of what it was when we lent to you, take equity then and don't take the dilution. So we extend their runway. And I think the little known secret that people don't quite understand is that on every loan we take, it's 2 components. One is just interest. The other is warrants. And we've got a portfolio that varies. Some are in, some are out, some get bought out, of 15 to 20 positions that continues to grow over time. And those warrants in high growth companies, whether they go public or not, they usually get bought out at some point within the next sort of 6 years. Those warrants represent really interesting upside for us. And so what we do, to summarize, is we lend money, high growth companies, primarily tech, and we help them grow their businesses. And then what we do is we manage our business and flow out we don't really pay dividends, but we basically reinvest the money that we make. And, one of the slides I'll get to is we've grown our book value from a low of 44 cents to it's $1.23 now, which there's an asterisk there. I'll get to that in a minute, but it's pretty darn good growth in book value over the last 5 years. So 130 million deployed, 60 deals, 15 active, 12 warrant positions, 3 equity positions. And one way to look at it is we empower the entrepreneurs of the modern economy. And I'll tell you, it's a much different environment right now than it has been for a long, long time. When we started this business, we took over this business about 5 years ago. It was a turnaround. But a couple of years ago, when we came to talk to you, one of the there's kind of a couple of challenges. One, finding really good deals. Two, finding capital. We've been, for the last 12 months, the number of deals that we've seen has been steadily increasing. And that started 12 months ago when you started seeing inflation, you started seeing banks, which tend not to lend to our sector, but nevertheless, banks were starting to sit on their hands, not take risk, right? They were risk-off trades. You then saw venture capitalists, when the equity markets came down, venture capitalists started getting nervous about investing in the market, just like banks would. Moreover, venture capitalists don't want a down round. Companies started cutting their costs to make sure they could get to cash flow break even. And all along, we started seeing more and more deals, and a bit cliche, but it's been a tsunami of deals for us in the last 6 months into our pipeline. Call it 3 months. We've never had a pipeline as big as we've had. I think I've said that before, but it's true. It's bigger than it was before. We have over 5 deals that are signed term sheets in due diligence. We have more that are waiting. And it's really been a function of the equity markets are closed, and or equity markets, equity investors tending to be venture capitalists, don't want to invest because they're trying to avoid a down round. And let's put it on the table, there's a new shiny object out there called AI. And so all this venture cap money that's looking for unicorns, 10x, 20x investments, are no longer paying attention to these companies that are generating 5 and 10 million in revenue and have good businesses, but they're not going to be unicorns. And those companies are now coming to us and others like us in the industry. And so it's been a remarkable kind of a journey to get here. Our portfolio, I'll talk about that in a few minutes, has been performing really well. But there's been an incredible uptick in the quality, the size, and the number of deals that we've been seeing in our pipeline. And just quickly, I know there's a lot of stuff on this, but on the screen, but we look for revenue generating companies, generally annual revenue of greater than 4 million in terms of recurring software revenue. The majority of our portfolio, we're open to all high growth businesses except real estate, mining, and resources. And I know you guys do a lot of work in that area in small cap, and that's all the power to those companies that are focused on that. We're just focused on tech and high growth companies. 80% of our portfolio is in the tech space. Our investments will go from $1 to $7 million US. We do Canada, the UK, and the United States. About 75% of our portfolio is in the US. About 15 in the UK. About 10 in Canada. The UK is a great place to invest, by the way. It's underserved from players like us. By the way, our market, the venture debt market, represents 30 billion in annual originations. So $30 billion US of new loans are written every year to the kinds to companies who need capital to scale. Now we're at the smaller end of that scale. Companies like CIBC Innovation Banking, RBCX for Canadians, Silicon Valley Bank, and others are at that higher end of the scale where they're doing $100 million loans to companies doing $200 million in ARR. So we're at the smaller end of the scale, but not necessarily the riskier end of the scale. Obviously, there's a little bit of a correlation between revenue size and risk. But, as I say here, we focus on profitability is not required, but we need to be comfortable that you have a path to profitability. And we do equity level due diligence. As I said before, we're focusing on taking debt level risk with equity like upside, but all the team members have come from an equity background, and it takes us 6 weeks to get comfortable. This isn't sort of, hey, you've got 3 vehicles in your fleet. We'll put a lien against those assets, and here's your money. We're generally lending to asset-like companies, and the value they have is in their intellectual property, their market share, and their growth. And so we don't really rely on asset value when we make our decisions. Having said that, we generally are on average, at the time of investment, our loan relative to the enterprise value of the company is in the range of 5 to 7, 10%, let's say. So high growth, they don't have to be generating positive cash flow or profitability, but they have to have a path to that. And or we have to feel strongly that they're a fundable company, and by the time they get to the end of our loan, they should be able to either refinance us with cheaper bank debt, or they will have been acquired along the way, or they will have taken an equity investment to help them scale their business. And many of our exits, including Kovo, which I think we just spoke offline, they took an equity investment and they used the proceeds of that to buy us out. That was one of our portfolio companies. In fact, the last 3 exits we've had in portfolio companies, all of them raised somewhere between $17 and $70 million worth of equity, and we helped them get there. They got there because we invested in them in their growth phase, and that attracted more equity investors. So we spent a lot of time doing due diligence. We're seeing a record number of deals coming our way in terms of interest, because the VCs have just moved on, and we're performing well. I'm going to go to a slide here a little further on. Here is a revenue slide. So the gray line is our recorded revenue. The white line is our recurring revenue. The green line is EBITDA, and the dark green and the light green is free cash flow. Now, you might say, yeah, it doesn't look like you got a lot of great growth, Alex. And I will say it's flatter than we like, but remember, our revenue is based on how many investments we've had. And we've had a lot of, actually, we had, I think in 2021, we had, don't quote me, it's somewhere 6 or 7 exits. In the last 12 to 14 months, we've got another 3. So we've had more exits than we've had deployments. It's been a point of frustration for me, but it's driven fantastic free cash flow growth. And, I will say last year we had 5 deals that we'd signed term sheets on that we didn't close on because they failed in our due diligence process. So, so this is a picture of our growth in revenue and reported revenue and recurring revenue. As you know, we currently have 10 million in cash on the balance sheet. We're going to deploy that plus additional capital, and you'll start seeing our revenue grow fairly dramatically as we deploy our cash on our balance sheet. And look, our objectives here, as I mentioned, it was a $30 billion a year origination marketplace. We're just looking to get from 60 million in assets to 150 million in assets. We're still going to be a very, very small player in what is a big market. And as I said earlier, there's a lot of positive wind at our back in terms of seeing new companies. Here's one more slide that I think is worth talking about, and that's our book value per share slide for shareholders. So the one to look at, the gray line is our book value per share as reported, and the yellow line, or orange line, I should say, is our share price. So we've grown our book value from a low of 1 quarter prior to this, 44 cents, to 97 cents today, excluding our tax asset. And you'll see a big jump here from 95 to 122. That's because we have been profitable now for 3 years. We have $32-ish million in tax losses from way back when, prior to our turnaround. That is, as long as we're profitable, we're going to chew through those losses. And so our auditors insisted that we recognize that as an asset. So, which to me it's a valid asset. It turns into cash as soon as we generate profit. But we've grown our book value, excluding the tax asset, by well over 100%, from 44 to 98. Including our tax asset, it's approaching 176%. So we are generating great returns for our shareholders. Our stock is lagging. But that's not because of a lack of performance. I think that has to do, you probably know better than I, Paul and Trevor, about just, maybe people not that focused on small cap markets at this time. I want to show you a bit more. I'll pause there to see if you have any questions, Paul, or do you want me to talk a little bit more about our performance?
No, just absolutely keep going.
Okay.
We'll follow up some questions.
So I'm going to show you, let me know, this isn't quite full screen, but let me know if you can see this. So this is our IRRs by investment date from our history. Now, this goes from January 2013 until now, so about 10 years. And what I want you to focus on is kind of a imaginary line right here, right where my that's when my cursor is. The company was originally called Grenville Strategic Royalty. You may have heard that before. It was a small cap company. It was public. Grenville did royalties. In hindsight, they did a really good job early on, but the risk profile and the returns that they were getting was not conducive to. You'll see that on the left side of the screen here. They had a lot of winners and some of them really good returns, and they had a lot of losers. And on the back of that, that's where the losses came from. In March of 2018, we merged with Logic Asset Management, which was the old Aston Hill and Front Street Capital. We corrected things a little bit, divested most of those assets, and that's when we pivoted from what were royalties into what is now our core market, venture debt. On the back of venture debt, this is the performance of our portfolio, basically since this line right here, since March 2018. I'll give you a number. So that's our performance by investment. I've just numbered them, so there's no name. Here's our return multiple of invested capital. And here's our IRR. And I'm going to just select for type 3 deals, which is deals after, just give me a second here. So our IRR, since over the last 5 years on every single one of our portfolio investments, our IRR is 30.5%. So that's why we're so excited about what it is we do. And some of that has just come from our, we've had some losses. Our loss ratio over that time period is about 1%. Quite honestly, that came from a cannabis investment, which we don't do anymore. As I said, we're almost exclusively technology now, but we're investing in sort of the up and coming companies in the tech space who need a bit more capital to extend their runway, and we make money from cash interest, and we make money from the warrant portfolio in some of these companies. So I'll give you an example. We made an investment in June 2021 in a company. The equity value of the company at the time was 25 million. We gave them $3 million. They did a fantastic job. Less than 9 months later, a tier 1 VC in America came and invested 70 million, 50 million secondary, 20 million primary. That triggered a change of control. It triggered an exit, essentially on our exit bonus / warrants. And in the span of 9 months, we put in 3 million. We took back our principal plus another 2.25. Now, that's a rare instance. Please don't expect all of our investments to be that successful in that short a period of time. But that's an example of why we love investing in these kind of companies, is because those types of returns are, I wouldn't say expected, but that's the business model that we invest in, which is high growth companies that can afford our debt, that want to extend their runway, that we have equity upside. And so, some people try to do public venture capital. Some people try to do sort of public, there's just all these other models. And having been an investor and on Bay Street as an analyst and Wall Street for a long time, this is, from our perspective, it's not for everybody. It's kind of the best investment model. It's regular cash flow that covers our expenses. We don't need super big home runs. We just need companies to continue to execute. And so many of them are going to get acquired over time that, those bonus on exits, those warrants, that's going to add a very material part to our IRR over time. So I'm going to pause there. I think that's, for the most part, what I wanted to cover in terms of our history, in terms of what we do. Kind of brings us up to speed from the last time we were on the show about a year ago. And maybe see if there aren't questions or clarifications that I can provide.
You got it. I want to remind everybody that's listening, if you do have a question you'd like me to ask Alex, just use the chat function and I'll ask the question. You touched a little bit on AI and some of the stuff that's sort of exciting around that, but are you seeing other trends? What kind of companies right now, if there's a sector within tech that you're seeing more of right now?
So, interestingly, let me answer a question you didn't ask, but I'll get to your question in a second, is do we have any AI companies in our portfolio? And the answer is no, with one exception. So AI, the value in AI is the unique data set that you might have in order to train the AI to do something. I'm a huge believer in AI as not just machine learning, but true AI. We have one company that is in the vet space that has done about 2 million, approaching 2 million chats, live chats between live veterinarians and live pet owners. And they stored that database of chats for years and years and years. And suddenly AI, ChatGPT, and they've now basically trained a generic version of AI with their unique data set. And they're not commercializing sort of an AI trained veterinary application to help scale their business and attract more customers. And it's early days, but it's getting a lot of traction. That was them taking advantage of a unique data set they had. That was not us investing in an AI company. We invested in a company for other reasons. But that's the only company that we have that really has AI exposure. I actually don't think that we're going to see, I'm not seeing a lot of AI companies in my pipeline. You know, we have hundreds of millions of dollars in qualified leads and deals in our pipeline. Very, very few of them are AI or pure AI. AI to me is sort of the leading/bleeding edge of the wedge. There's still early days, still a lot to be determined. What are the value propositions? What are the use cases? We happen to have one in our portfolio that I think is going to excel in its use of AI. But we're not seeing a dramatic number of AI companies that meet our criteria, you know, revenue generating, break even, etc. To be honest, the trend that has been here for a while, it's SaaS, it's software as a service, be it B2B, B2B2C, B2C consumer products are out there. But we're a little agnostic when it comes to trends, and trends can flame out, right? Hate to point to it, but crypto, other trends, what we really look at is this a good business? Does it have a sustainable moat? Not by the Warren Buffett definition where it'll get to be billions of dollars, but something that it competes against it's in its space well, it has a value proposition. And you know how we prove that? Not by companies telling us what they do, but by speaking to customers. Calling the customers, understanding that why they buy this product, how did they find it, you know, what did they, you know, and how is it performing? So we're agnostic as to the trends. They bring them to us. However, it's overwhelmingly tech, because that's where most of the growth is. When you talk about $5 and $10 million companies that are growing at 30 or 40%, those are tech companies usually. So it's, I wish I had something for your shareholder, your listeners that I could point to as the new thing. And other than AI, it's really, to me, for what we look at, it's good management, good governance on the board, good defendable, you know, product set, value proposition, etc. But there's no trend that really sticks out from the things that we're seeing in our pipeline.
Alex, obviously over the course of the last year or so, we've seen interest rates have moved a lot. Give me a sense of how do you guys manage interest rates? You know, you guys charge interest rates. How do you manage that in the light of the sort of the change in interest rate environment?
So we're lucky. Great question. So we're lucky that we have our current sources of capital are fixed in terms of their interest rate. We have a debt structure called the Priority Return Fund, which is about $18 million, and it's fixed interest rates. Most of our deals were fixed interest rates. And we've started to use floating rates. And actually, they're not exclusively floating. We give the company an option. You can have a floating rate, which is higher than the fixed rate, but will eventually come lower than the fixed rate, or you can take a fixed rate. And that fixed rate is a little higher, 1 or 2 percentage points higher than it used to be. Most companies are opting for the fixed rate, and I'm okay with that because our fixed rates are in the range of 15, 16, 17%. And again, I explained why this makes sense for the high growth company that's taking that money, because our cost of capital is lower than the cost of equity. But we're not seeing the compression in our cost of capital. But also, interestingly, in the dynamic, when you're charging in the 15s to 18s, there's not a lot of room to go higher. So interest rates have gone up at the low end, at the risk-free rate and Fed funds rates and overnight rates. But our rates haven't gone up as much broadly in our industry, not at this rate. They've gone up a little bit, maybe 200 basis points, whereas Bank of Canada rates gone 400 basis points. So there is a little compression, gross margin or spread compression, but we're still high at 17 relative to where our cost of capital are, that there's no risk. I don't feel there's any material risk of us, of it impacting our revenues dramatically. A little bit of a profit hit, but there's so much opportunity for us to deploy more capital that, the ability of us to spin off free cash flow, many multiples of what we're doing right now is, even at these rates, even if we went to a variable rate funding rate, where currently our average cost of capital is in the 9.5% to 10% range. Even if you went to the people that we're talking about long-term lines, they're a little bit higher. They're 11, but they're variable and they'll come down. So I think I'm no economist, but I do think that we've got no problems because of our fixed source right now. And I think we're closer to the top of the cycle of tightening, of rate hikes than the beginning. And so even another 100 to 200 basis points higher, don't worry.
Now, Alex, you mentioned when you're quoting sort of interest rates, you mentioned a range of sort of between 15 and 17%. What does a company what influences you to have a different rate for a different company? I'm just trying to think of the different risk factors you're looking at that would price out.
Look, there's a little bit of slightly higher risk, slightly higher rate, but it's kind of a margin. We're either going to do a deal or we're not. Like there's no it's a bit of a hairy deal. Let's charge 19 and let's do the deal. We don't do that. Honestly, it's a bit of an art. It's a bit of a what can the company bear? What do we need to get to win the deal if it's a competitive deal with multiple term sheets from other providers? But we've had plenty of companies come to us and say, we've got term sheets at 12. Do you want to match? And we're like, no, we're at our best rate. Thank you. Good luck to you. So we do an internal risk assessment. We do, as I said, an awful lot of due diligence, and there's some influence on the rates. But for the most part, this is a good company, got great protection on the downside for various reasons. And that's what we look for is how do we get out? What's our protection? What happens if things don't work out? Let's haircut their forecast by 40%. Where does that put them? What levers do they have to control expenditures? What levers do we have to control their behavior? And it's gone up from 15.5 to 16.5 because rates have gone up. But for the most part, we're probably within 100 basis points on every single term sheet we issue to a company that we want to fund.
Gotcha. The remarkable sort of increase in book value per share here. Share price hasn't gone anywhere, and I would agree. The microcap market right now is not exactly conducive to almost anything out there. But what levers do you have ultimately? Do you think to change that apart from just doing what you're doing? Is there anything else you can do to sort of shrink that gap?
So I think I can do a better job of going out and talking to people like you and your subscribers and the street. As I said, 5 years ago, we restructured this business, and I think we now have a 5-year track record of pretty good performance that we feel should resonate well. I think I think our first interview was 2 years ago, and somebody might have said, well, okay, 3-year track record, but what are you going to, and now it's 5. And our results have only gotten better. So I need, we've never done, I was an analyst. I've been on the street for a long, long time. You know how the game works, but I've never really done a concerted effort to go out and tell the story. I could increase our volume a little bit by getting more people interested. But number one, my primary objective is to keep doing what we're doing, meaning keep building the business and keep performing well and generating shareholder value. Yes, the stock will in some sense take care of itself as long as we keep doing it, but I've got to get out there and tell the story. So that's really my objective is to do more of a roadshow or multiple roadshows, right? And
Gotcha.
start telling the story more.
Gotcha.
I wish there was some magic bullet that I could just, but it's hard work. You tell me. Paul, what else can I do?
I think you nailed it. You got to keep performing, and sooner or later, everybody comes to their senses. But sometimes
I do hope volume gets higher. The volume is growing. We do have an NCIB that we're pretty active on. we've reduced our share count from 44 million to 31 million. And as long as I'm buying dollars for 50 cents, we'll keep doing that. Sometimes we pause because when we need the cash to make deployments or whatever, but we've been one of the largest purchasers of own stock, and I think we'll continue to be that way. And if you read some of the books on some of the best performing stocks in history, it's share buybacks, right? So we've got a track record of doing that. I know our board believes in it. I think we'll just keep doing it.
Gotcha, for sure. Remind, like, insider ownership and just the general makeup of the shareholder, maybe remind us what that looks like.
Fully diluted insider ownership is 27%, give or take. 27. We also have that debt fund that I mentioned. We have about 10% insider holdings on that debt fund. So, we own, the way I look at it is every dollar we invest, a substantial portion of it is our own money, and that's across the board and management. Don't think we have a lot of institutional ownership. I know of a couple who I talk to regularly. I think we're still a little bit small. But I compare this, like most times you'll see a venture capital fund or a debt fund in a GPLP structure, not public. We're public because back in the early days of 2013-14, our predecessor company was doing permanent deployments for royalties. They needed a permanent source of capital, so they went public. That makes sense. I've got $31 million in book value, attributable equity value, I should say, attributable to common shareholders. And that's something that I can use to lever my business, not in a leverage sense, but to help grow my business. That most GPLP structures, for listeners, that means general partnership, limited partnership. So kind of a private limited partner run by a group of general partners. They at best, you'll get a pari passu structure there. Since our money, the insider money, is in the common shares, that's how we're building shareholder values, by focusing on making sure that we're making the right decisions to grow book value that's attributable to common shareholders. So long answer, but 27% insider ownership, which I think is a material number relative to other models that do similar types of investments.
Gotcha. I got a question that came in specific to a company. Did you guys participate in a recent financing of Level Jump Healthcare?
So no, but Level Jump was one of our portfolio companies that, to be honest, went into distress. It was an investment that was done prior to me getting here. And we worked with them, sometimes contentious, but I'll give the guys credit. They've done a good job. At least I to be honest, I haven't tracked them for a long time. But while I'll look right here, we are a common shareholder of Level Jump, but we did not participate in the recent financing. And once they're public, we don't do equity financing. So we converted some of our then debt into equity, and that's why we own common shares. So I got a long history with them. I know them, but we haven't had an investment into them for probably, I think the conversion was 2020, and it was probably 2015 when we made the initial investment.
Gotcha. Thought came to mind, like, how long does it usually take from sort of finding a deal and completing your due diligence and funding?
So good question. It's never fast enough for our investing companies. And,
of course,
and somebody will ask us, how long does it take? And my answer back or question back is, how ready are you? Do you have your materials like this again? So, as an analyst back in the day, when I used to talk to the institutional investors, they'd read the financial statements, they'd look at my model, we'd have a chat, and then they'd make an investment. That's not the risk profile. Like this, that's not what we do. As I said, we call customers, suppliers, we stress test the model, we go through product demos, we do this. So the answer is, once our process is leads come in, we qualify the leads down to a level called preliminary IC, preliminary investment committee. That means the business fits our broad parameters. They understand our rates. We kind of like it. We write up a 2-page memo. We then have an all hands meeting. This is prior to term sheet. At the all hands meeting, where management presents to us, we ask a lot of questions. We then risk assess, do we want to do this? And we decide to do a term sheet. And that's where we decide, 15.5, 16.5, whatever the interest rate is.
Mhm.
We then sign a term sheet and we then start due diligence. It's funny, when we first send our due diligence checklist to the company, we always say, don't let this list scare you because it's huge.
Mhm.
Let's talk about what's relevant for you and what's not, because it's a generic catch-all list that not everything is relevant for all companies.
Yeah.
And then they provide us everything. And it takes us realistically about 4 weeks to do due diligence, and documents probably takes about 6, which is concurrent. So the fastest we've ever done a deal is 5 weeks. The average is probably 8.
Yeah.
I can see it go to 10. It's just because that's what it takes. And as I said, last year, after signing a term sheet, we passed on 5 different deals because they just weren't of a high enough quality, and we didn't feel strongly enough about the security position that we had in our investment.
Gotcha. What as investors watching the business right now, where do you think we should continue to sort of focus on? What are the key metrics that make the most sense to watch right now?
So we need to make more deployments, and that's not a failure in the business. That's being a bit selective and various other reasons. So to see our revenue grow, watch our deployment rate, and we press release all our deployments. B, watch our exit rate, and or when we have a material win on our warrants, we'll talk about that. And cost control, and then really out of all, you combine that, we're going to start. It's really about free cash flow. So internally, I'll go back one slide here if I can. There. So IFRS, like GAAP reporting standards, make you flow through changes in your balance sheet. So let's say we change the value of a warrant, has to flow through the income statement under IFRS rules. And I'll be honest, I feel really bad for potential investors, because it's last year, I think we had 7 or 8 million in revenue, but $15 million in profit. How is that possible? Under normal kind of, if I came to you and said I generated 8 million revenue, but 15 million in profit, it's a ludicrous non sequitur statement. And the reason is because of the intricacies of IFRS. And so what we focus on internally is cash flow from recurring operations, very much like a software company, which is really interest payments. We then have bonus on exit. When a company exits early, we get a 6-month or 8-month prepayment of interest. We then focus on closing fees, and there's some amortization revenue in there. And so we add it all up, but the gray line is revenue from interest sources. That's not necessarily recurring revenue. The white line is recurring revenue. So for example, in this quarter here, Q4, we had several exits and several prepayments of interest that had to be recognized as interest revenue, but it was one time. It was still cash, it was still good revenue, but an internal metric that we use is recurring revenue, and that's what we're trying to grow. And I talk about that on every conference call. And the other one is, how much free cash flow are we generating per quarter? 100,000, 200,000, or per month, 100,000, 200,000, 300,000. And look, if we're generating what I think we can generate in the next couple of years, right now today, we have $36 million in revenue generating assets, $4 to $5 million in our warrant portfolio, 10 million in cash, and 10 million-ish, 8 million in our tax loss asset. We take that revenue generating asset from 32 million to 64 million, our revenue should double. And we're not going to incur dramatically higher costs. There'll be some interest expense because we can't fund it all through equity, but a big chunk of that'll fall to the bottom line. And really, that's our job, finding good companies to invest in. And I'm glad to say that we're seeing some really, really good pipeline, as I mentioned several times now, traction. So watch our revenue growth, watch our deployment rate, watch our free cash flow. And what you'll see as we do that is that the gray line will keep growing because we'll keep growing book value, and I'm going to do my best to get those shareholders to continue to buy the stock and then follow us up. Now, I will say, on the shareholder side, one of the pushbacks I've heard from potential equity investors is you don't have enough volume. I got to tell you, I know people who bought 5% of the company, and it took them a couple months to acquire. That sounds like a long time, but that also means you could sell 5 or 10% of the company in terms of the volume of trades. So it's not like it trades by appointment. like you
Mhm.
sometimes see in small cap, and we're increasing the volume. But I would push back on investors. Look, maybe a large institutional fund manager who's got hundreds of millions or billions to deploy, we're too small. But for the average investor, I think you can get an excellent position by being patient, both on the buy side and on the sell side.
Mhm. Perfect. Well, I think we've covered a lot. Alex, is there any sort of key takeaway or last message you want everybody to walk away with today?
Look, we've been here 3 times now, and every time I say keep watching our performance, and I'm just going to say it again. I really appreciate your support and your platform. I think we've done it for 5 years, and I think we're going to keep doing it. Look, I'll be happy to keep a 20% IRR, let alone a 30% IRR. And to be fair, you know, it's not all unicorns and roses and rainbows, but it's such a good market to be in relative to some of the other investment opportunity type companies that exist on the various exchanges that we're just going to keep doing it. So thank you for your support. And if anybody has any questions, comments, go to our website, materials there, and also feel free to reach out directly. I'm happy to take investor calls.
Fantastic. This is awesome. We've been speaking with Alex Baluta, CEO of Flow Capital, symbol FW on the Venture Exchange. Alex, thanks for joining us again today.
Thank you, gentlemen.
Awesome. Cheers.